Mr. Stefano Dova, our guest, has been presenting a very interesting presentation on the bank business models and this intermediation process whereby new lenders are appearing on the market, direct lenders, and you know, this is a very interesting, very also challenging process and evolution for banks. And you know, Mr. Dova has given us a very interesting picture of the evolution of the financial industry. And not only, but also leveraging on his expertise, we have been able to know something about the most desirable skills today for bankers and people working in the financial industry. But this has happened in the very first part of the morning, which was dedicated and targeted to our full-time master students. Now we are open. I'm very pleased to open this more open session, which we propose to all our community of students, former students, and whoever is interested in the topic. So again, I'm happy to introduce again Mr. Stefano Dova, Head of Markets in Mediobanca, a very important financial institution, covering very broadly the different areas and the different activities in you know, collecting money, lending money, and managing funds in many perspectives. And but the topic at focus is a very new, relatively new one, but it's a topic that will become soon very key for not only for the banks but for all corporations. ESG and ESG criteria as applied to finance. So the title of this session is ESG Finance. We have already been introduced to this topic very recently with a very interesting presentation by Banca d'Italia here in this room. They presented their view, their analysis on green bonds in particular. And we also know that many stakeholders of ours, for example, Generali, for example, Allianz, they are active in also investing in green areas. But ESG is more and is broader than green. So we would like very much to listen from Mr. Dova about his perspective on the topic and where do you see, you know, the evolution going and whatever, you know, you consider for us important to know. So the floor is yours, Stefano Dova, and thank you again for being with us.
All right, thanks very much. Thank you to the faculty for the invitation. As mentioned, my role in Mediobanca is within the markets division, which I'm heading. And naturally, as a market participant, we are exposed to any novelty that is being brought to the market. Either from ourselves or from other market participants. ESG is one of those. It's a very new branch of finance. It's all-encompassing, and it spurs from the world's need for better social responsibility, a greener world, and a more responsible allocation of resources. So it's a very, very broad concept. This is an introductory page that is bridging from my earlier discussion on lending and direct lenders and new market participants that are disintermediating banks. Well, in the ESG framework, banks are not so much disintermediated as in other branches of finance, because it's a new thing. It's difficult. It's still very much in development in terms of regulation. There is still very little regulation, and there is therefore the need for institutions to put their stamp on what it is that is to be considered ESG. Therefore, this little chart about barriers to entry and the fact that still, for the time being, banks and regulated financial institutions are at the forefront of this new branch of finance, being ESG. So, a few words about what ESG is and how it can be structured. I hope you can all see, I've got a very small font in some of these slides because there's a lot of concepts to talk about. So let's first start with what we know. ESG is a stamp, a categorization of financial instruments. We know there's been the Scottish conference about climate change. We know that the world is very focused on climate change, on improving our chances to stay on planet Earth and foster planet Earth for as long as possible. There are two main categories of ESG financial products. There are the green, social, and sustainable products, and there are the sustainability-linked products. What are the main differences between these two? Well, category number one, green, social, and sustainable debt, is about what you do with the money that has ESG green stamp on it. So if you're, for example, a financial institution like a bank, Mediobanca has raised the green debt recently, you have to use this money for certain special projects that have a green flavor to them. And by green flavor, we'll see what it means. There's actually a number of very prescribed things and rules that you have to respect in order to maintain the green stamp. If it's sustainability linked, it's something else. You can do with the money what you want, but you, dear bank or dear corporate that are raising sustainability linked money, have to improve your footprint. Your footprint means, of course, in terms of pollution. If you're E&I, try and put some filters on your chimneys in the refineries and make it less polluting. But you could as well say that you're being sustainable because you're helping the economy in the recovery after COVID, or you're financing hospitals for research projects, or you're doing other things that all encompassed within your corporate purposes improve your ESG footprint. It's two very different things. One is dedicated money to ESG projects. Two is non-differentiated money. You can do what you want, but your company has to show me that you're improving your footprint. ESG categories, you can see them by yourselves. Of course, green buildings, energy efficiency, clean transport, pollutions, renewable energies. I'm financing, I don't know, solar panel plants. Affordable infrastructure, social projects, social housing is an ESG category. The development goals, they are mostly affecting sustainability. So, for example, as a corporate, I'm helping life in the sea. or I'm helping recycling, or at the same time, I'm helping food operators, food distribution, a better redistribution of food. I'll give you an example. I don't know how many of you know Pret-a-Manger. It's a food chain. It's mostly famous in the UK, or I don't know, Starbucks. Everybody knows Starbucks, right? What are they doing? Well, at the end of the day, whatever has not been consumed, they take it to the food banks. This is a sustainability activity because I'm helping food distribution and redistribution. So the ICMA, which is the International Capital Markets Association, is the authority that regulates debt instruments, and not only, but mostly in this case, debt instruments. The ICMA is helping determining what is ESG, because there is not yet a unified regulation and interpretation about ESG throughout the world. So the ICMA, which is a bunch of guys like ourselves and other financial institutions, they come together, they have an association, and we say, okay, this is going to be ESG. ESG bonds. As mentioned, there is a very clear focus on the use of proceeds. The use of proceeds is therefore targeted to improving the world in one of those categories. There is naturally also a process that we have to respect in order for the companies and for their debt to be categorized as ESG. It has to have objectives. It has to have a very defined process. And usually there is an annex in the financial statements of a company that comes out and tells you what the process is. And of course, the eligibility criteria have all to be respective. The management of the proceeds, as I mentioned earlier, is key. And normally, there is a requirement by a third party to evaluate what is considered to be ESG. It's almost like an audit of the audit. So while your balance sheet is normally audited by an external auditor, you have to have your ESG footprint audited as well. And this also is relevant, of course, as I said, with the reporting. There's a special reporting that is different between the green, the category A, so the green, social, and sustainable debt, and the sustainability link. There's two different types of reporting because, of course, in the one case, you have to report about the projects that you have to finance, and in the second case, you have to report about your overall corporate impact. And naturally, this is all coming down into documents that have to be printed and readily available for the public on a regular basis. Sustainability linked is category number B. KPIs. So as we said, in category A, I'm telling you, look, you're giving me 100 million. I have a green bond. I'm building with 100 million, roughly 1 gigawatts of solar power plant in Friuli. And that's easy to monitor, right? Because I'm the investor, I've given you the money, even cheaper than you would normally raise. You tell me you're lending it to the power plant. If I go there and the power plant is not there, it's missing productivity, it's not producing, you didn't buy the solar panels, I know you're not compliant. In this case, I'm giving you 100 million, and I, company, I'm promising you, I'm going to improve the environment. If I don't improve it, I'll pay you more on the coupon. Normally I pay you 5%, I'll pay you 6% if I fail in my ESG purposes. But then me, investor, I'm telling you, okay, what are your purposes? What are your KPIs? They have to be relevant, core, and material. You can't tell me I'm going to pollute less and the improvement you are making is 0.01% on your standard pollution. That's not acceptable. Measurable and quantifiable. You can't just tell me I'm going to use less electricity for, I don't know, making coats. You need to tell me why and how much. Externally verifiable, naturally, so you need to provide access for the verification. And you need to be able to be benchmarked, because the fact that you're telling me, oh, you know, I'm E&I, I'm going to produce 10 million tons less of CO2 a year. Okay. But I need to see if that's relevant with respect to what Total is doing, or Exxon Chevron, or any other oil company. Otherwise, it's not acceptable. The calibration has to do with what I just mentioned. So you need to bring a significant improvement. The debt characteristics. So while in a green bond, I'm doing a green bond, normal coupon would be 3%. I'm telling you it's green. It's good for you as an investor to invest in green. It's good for me to show that I'm doing something green. Let's meet at 2.5%. For a sustainability link, this is not possible. It's general corporate borrowing. So what we're going to do is the following. Let's put it this way. I promise you I'm going to be a good boy, and I'm going to do something good for the environment, or for social purposes. And if I am not good, I have a step up. So I'll pay more on my debt because I failed. That is what the debt characteristics usually are in the sustainability linked bonds. I've got a few examples later, so we're gonna flip through them. Reporting, similar story as with the green energy. It's only a lot more difficult because it's very generic usually. And verification, same story, has to be with an external auditor. ECB eligibility. Now this is important. While green bonds usually are ECB eligible because they are plain vanilla instruments, they just have a stamp. They're printed on green paper instead of white paper. Sustainability linked bonds are a bit weird. They have these coupons that change depending on how good I am with the ESG and so on. So there was a bit of a topic with respect to the ECB accepting those as collateral for the standard ECB capital market operations. Do you all know how the ECB works with respect to bonds? No, okay, good. So usually banks, which are utilizers number one of the ECB, have a bunch of bonds, and they take these bonds and they bring them to the ECB and they exchange it for cash. So you remember the bank's balance sheet, you have a number of securities on the balance sheet, you may have green bonds, and once you need cash, you go to the central bank, bring the bonds, and they give you cash. Some bonds are not accepted by the central bank. If you take a junk bond to the central bank, they don't want it. If you take a structured bond with a funky coupon, exotic payoffs, etc., they don't want it. So there's been a lot of discussions around the fact that these structured coupons or the sustainability-linked bonds would or would not be accepted by the ECB. If they're not accepted, it's not very good, is it? First of all, I'm doing something social, something sustainable, and the main European banking regulator is not accepting it. Well, they've lifted this veil of uncertainty on the 22nd of September, saying, okay, guys, we recognize the fact that it's a sustainability-linked bond, and therefore we will be accepting them, even if they have strange coupon structures. It's good because the market, this is one of the examples where the market had moved faster than the regulator, and it normally is the case. The regulator always plays catch up, but in this case, of course, it's one of the main recognitions that this is a good thing to do. Some more comparisons, because this is one of the key things to remember about ESGs, the different categories. So yet again, what is a green loan or bond? It's something that is available exclusively to finance or refinance eligible green projects. And what are these green projects? Renewable energy, pollution prevention, environmental sustainable management, aquatic biodiversity, etc., clean transportation, water and wastewater management, climate change, eco-efficient products, green buildings. For example, there's these buildings that have zero carbon impact. If you want to finance a developer that wants to build a zero carbon impact building, you can do this with a green bond or a green loan. Sustainability linked, much broader. And as I said, it can be used for general corporate purposes. Energy efficiency seems to be the same as in the green bond, but it's not. Energy efficiency here means you are going to use less energy for your production cycle. I don't care how you do it. You just have to do it. Greenhouse gas emissions, the E&I story. Renewable energy. Again, not financing a solar field, but using renewable energy sources for your production process. Affordable housing, this is something in the social space that in the green bonds is much more difficult. But you will have a certain percentage of your mortgage loans allocated to affordable housing. Circular economy, sustainable farming, like the very fashionable zero-mile food now. You eat what it grows in your region, etc. Right. Some more specifics around the process. Project evaluation and selection. Naturally, as I said, in the green space, very focused on the individual projects, and the management of proceeds as well, credited directly to the utilizer's account. In the second case, so in the case of sustainability linked, you will have a very strong relationship between the corporate social responsibility strategy, which is published. For example, Mediobanca has made a publication of that, and our CEO has made a declaration no later than last week around corporate social responsibility. And all these targets are obviously measured and declared in advance to be then benchmarked against the objectives. Right, this is super small. Sorry. But the chart is quite telling. So let's look at the chart. See how new this is. This is the evolution over the last 3 years of ESG market. DCM means debt capital markets. So it's the public markets, really. But look at the chart. It's quite astonishing. So in the first quarter 18, you had just a tiny bit more than $30 billion equivalent. And look at now. We're almost 10 times. We're going to hit a record this year in 2021. Probably also thanks to the numerous conferences on climate change that there have been. And probably this market is going to do more for climate change than lots of the recent declarations, because ultimately economic convenience is driving most of the human's choices. And if you don't have economic convenience to do something, it's very tough to convince people to change. And we'll go through it and we'll understand what economic convenience means also in respect to ESG, and again, the influence of regulation. Look also interestingly at the development of the market. It's born with green because it's easy, right? Green is very easy. I'm investing in this thing, this very specific identified thing. So whatever money you give me, it's in here. And so people always start with easy. Then slowly we see the emergence of sustainability, which has picked up in growth quite significantly. There are other categories here. Social, very important here. Why is it important here? Social. What happened here? From here to here, what happened? Who knows? COVID. So there's COVID. The world is in disarray. And so finance comes in and people start raising debt for social purposes. It's mostly banks, and we'll see it later. There's a bank also in Italy that has done an issue on social dedicated funds. It's mostly banks helping out the economy recover from COVID. Okay. Now, this is, until now we looked at the market and the private side of the market. There was no regulatory intervention, there was nothing here. Now let's look at what the European Union, since we're in Europe, has done with respect to trying to give some boundaries to the whole ESG topic. Taxonomy, big word. Essentially, it's about the definition of ESG according to the European Union. As I said earlier, the sustainability-linked bonds have been playing a little bit of catch-up in terms of both the investors' appetite. We've seen it's been growing most recently, and also in terms of the governmental intervention. We've seen the ECB coming in to accept those. The member states of the European Union have done, and the European Council naturally, have done a series of interventions in the ESG space. These are three examples where they have introduced ESG taxonomy. Energy transition labels, they have to do with the energy transformation, and they have a strict link with the recent conferences on climate change. The non-financial reporting directive. This is important because it's effectively almost compelling companies, both financial institutions and corporates, to publish an add-on that talks about what they think about green, sustainable, social, etc. Update on the French Article 173, which is a similar thing. So this NFRD, which is the non-financial reporting directive, has an application which is really quite broad. I won't bore you with the details, but it goes into determining which companies have to talk about ESG and defines them according to their turnover, investments, and expenditures. It's really quite a lot of companies. Most SMEs, the smallest ones, are left out. But quite a lot of companies are going to be forced to publish these reports. And therefore, they're going to be forced or strongly encouraged to raise this type of debt. Timeline for the implementation of the taxonomy. Well, it's very recent, as you can see. So there's been the publication in April. Delegated acts have been published in June this year. These are the delegated acts of the European Council. And by the end of 2021, financial market participants will have to disclose activities related to climate change mitigation and adoption. Companies under NFRD, they will have to be fully compliant with their financial statements next year. And of course, next year means for publication in 2023. What does it mean also in terms of the nitty-gritty of markets? Imagine I have a company, and imagine I'm not operating in, I don't know, Somalia, where probably people are not so interested in my climate footprint. If they're telling me to publish what I'm doing, and I'm doing nothing, I run the risk of being left out. Point number one. Point number two, I'm going to have a bunch of shareholders coming to my board meeting saying, why are we not dealing with climate change? It's a self-fulfilling prophecy. You see what's happening? So both the markets are there already. The regulators are coming in, they're saying, guys, you have to publish. If you publish something that is not significant enough, you will face criticism. So basically, there is a very strong momentum into encouraging companies dealing with ESG. This is a, let's look at mostly the graphs. It talks about, again, what it means for the European Union for something to be ESG. Again, quantitative threshold, relative improvement relative to yourself or the others, qualitative performance requirements, process or practice-based, so you have to define what you're going to do, and a precise description. This is all because you want to achieve these three taxonomy conditions for anything to be considered ESG. Substantial, no significant harm, minimum social safeguards. This is the typical investor's assessment of a taxonomy aligned instrument. So imagine you are, once again, general, and you have put in your corporate ESG strategy that 5% of the technical reserves have to be invested in ESG compliant products. What are you going to do? First of all, high-level analysis of what you have been presented. For example, a banker like me goes to an asset manager at Generali and says, hey, I've got this ESG bond. Do you want to buy it? And first of all, the guy has to go and look at the bond and say, it's interesting. Let me see the conditions and let me see whether it makes sense for me to buy it or not. Then he has to double check that my bond is actually respecting the taxonomy. So what the regulation that we've seen has just come in is telling them that is ESG. Step number 2 and step number 3 are obviously part of this. Step number 4, compliance with minimum social safeguards. So not only I have to respect the fact that it has to be a good project from an ESG point of view, but it also has to have a fair social impact. And step number 5 is, depending on how much of these 3 targets set by the European Council are respected, I will give an assessment, my own, and then the auditor will confirm it, of how much this is compliant with my ESG policy. Investors that are investing in ESG are a lot. Look at this. These are a bunch of guys that are putting their money and they have a specific target within their funds to invest in ESG. As it's often the case, we have a very strong focus from UK and Germany for 2 reasons. Number 1, they have in general a lot more money to allocate than others. And number 2, because generally speaking, financial innovation is much more rapidly accepted in the northern European countries than in the southern European ones. But as you can see, we have now a bunch of people, and this is by all means not the entirety of people. These are the guys that we as Mediobanca have seen extremely active, that we've had significant dialogue with. We've got people also, obviously, in Southern Europe being focused on this. These are private banks. Well, among these, really, part Italian, part French. But there's a lot of people here. And we are talking, all these people combined, we are talking trillions, okay? Trillions of assets under management that have a certain percentage allocated to ESG. Oh, This is very colorful, and I won't bore you with the individual details, but it's just to give you a sense of how many people, I don't know how many of these companies you'll know, but there's a lot of people here. And there's a lot of people that have done ESG with us as well. We are one of a handful of institutions that have an ESG practice. We have ESG structuring capabilities. So we're advising companies on what to do in order to print those bonds and be compliant. Look at this, just a few examples. Hera, it's a utility, Bologna. Enel, everybody knows. Erg, oil company, Genova. EDP, Electricidade do Portugal. A2A, Milan. Bank, Banca Popolare di Sondrio. Virgin Media, O2, mobile phones. Generali, Santander, Enel, ADR, Rome Airports, CaixaBank in Spain, Snam, Rete Gas, and again, Italgas. And as you can expect, if you see here, who are the guys that have mostly, in terms of sectors, that have mostly been tapping this market? Utilities, of course, it's easy. And banks. Well, utilities, because for them it's very easy to demonstrate how much they pollute, how much they're using energy, etc. They are either producing energy, consuming energy, but of course, they are the first sector that is impacted by ESG. And banks, why banks? Because they are lenders. To who? To all the people that utilize green projects. Few examples. For example, this one is September 20. So right in the middle, actually September was the COVID break, in between two lockdowns. We came out with a green bond. We've been financing green projects. Again, very compliant with the regulation. And look at the interest that we've noticed. Look at this. 220 accounts bought the bond. So 220 individual investors were there to buy the bond. It's a significant, very significant. I won't bore you with the, there's a lot of capital market details that you don't really need to know, but look at this. Do you know what this 7x means? Yeah, 7 times over. So we were offering $500 million. This was September 20. We were offering $500 million of investments. And of course, we had identified the investments, which I can't really disclose for compliance reasons, but assume it was something to deal with producing green energy. 500 million we were allocating to this investment. They asked us to sell bonds for 3.5 billion, 7 times over. Let's look at somebody else, NL. This is the different type of bonds. This is the SLB, or sustainability linked. What does it mean? It means that NL, which is a utility company and already has a lot of disclosure about energy impact, pollution impact, etc., is taking the step of saying, I want to borrow. I want to try to borrow a little bit cheaper than normally, And at least I want to try to borrow in a sustainable framework. So what am I doing? I'm printing my bond. There's a lot of data here. Don't be too concerned about this data. But what you need to look at is this. Step up margin. What does it mean? It means that I'm telling you that I'm going to be sustainable. I have a number of targets that I put in my corporate social responsibility statement, reduce pollution, etc., etc. And if I don't achieve those targets, I will pay you 25 basis points more on the coupons every year from the time that I start to fail those targets. So I'm actually punishing myself by paying you more if I don't achieve those targets. This is what I meant earlier with respect to the sustainability linked bonds. Now, turns out in this case that the bond was not actually so much cheaper than a normal bond. It actually ended up being slightly more expensive for NL than printing a normal bond. And I'm asking you to keep this in mind because we'll come back to this later, whether an ESG bond should be cheaper or not than a normal bond. Another example, as mentioned earlier, social. March 21st. Full vaccination campaign, lockdowns fading, economy on its knees. BPER, which is a very local and very locally rooted bank in Italy, comes out and says, okay, I'm going to invest in COVID recovery. It's very well felt by investors, and even here, 2.5 times oversubscription. So significant demand with respect to the planned issue. This is super small, but I'm gonna run you through it quickly because I think it's important with respect to pricing. You must be asking yourself, okay, so it's green, it's good, it's social, sustainable, should be cheaper all the time. Let's look at it. Okay, launch date, maturity, tenor. So what type of bonds we have, current ratings, they're all investment grades, as you can see. The coupons that they pay, the issued amount, it's always between 500 and a billion and a half. Only outlier is obviously the government that can afford to print much larger, especially on the back of the PNRR. Why? Because the government, one of the 4 pillars of the COVID relief funds issued by the European Union to individual countries has been effectively ESG, so green. And the countries have had to present plans in order to foster ESG. And the Italian government was one of them. And of course, they are now printing BTPs, so government bonds, related to ESG because they are using these funds to focus on those investments. But what's important is the next few columns. Pricing. So this is MS, means mid-swap. So it's the swap rate again, so the interbank rate, plus a certain number of basis points, the spread. IPT versus pricing is how much less they're paying with respect to what they declared was their maximum spread. But what's interesting is the NIP. So the second to last column. The NIP means, so if you had issued a normal instrument, not green, not sustainable, non-social, how much would you have paid more or less than this one? And look at the column. These NAs means that the instruments were not really comparable. But look at this, 0, -5, 0 to 5, -2. These are basis points, okay? So peanuts. 10 to 15 more, -10, -5, -10, 2, 3, 2, 3, 10, 8, 5, 0, 5. What's your conclusion? Exactly. So is it cheaper or more expensive to print an ESG bond or loan or you name it? ESG finance, is it cheaper or more expensive? Inconclusive. And it will stay so for a while. And you know why? The reason is simple. For now, there is no financial incentive to do ESG. There is moral suasion. There's a lot of people, including investors, that have a growing portion of their investments in ESG, but it's not yet 100% or 50%. Once we will see investors' portfolios with declaration of 50% of my investments will be in ESG, then we will see a crowding out effect, whereby, of course, other instruments are going to be sold to buy ESG. But for now, it's 5%, 10%. It's not big enough yet at a global level to influence the pricing. Second reason, ESG bonds end up in institutional portfolios. These portfolios are usually financed or refinanced with banks, and the banks in turn go to the central bank. Now, is there a regulatory advantage in keeping ESG bonds on your balance sheet? The answer is, who guessed it? No. There is no regulatory advantage. So if you're an insurance company, or if you are a bank, and you hold a bond on your balance sheet, and it's a normal bond or an ESG bond, and they yield more or less the same. Either the ESG bond has a lower SCR requirement for insurance or RWA requirement for banks, i.e. a lower capital absorption, or of course, I don't have any incentive to hold more of that, apart from the fact that I want to show off that I'm good and I'm ESG compliant, etc., etc., which at some point, as I mentioned, could become a really big topic. It's not yet. So we can't see a significant trend in pricing yet. Now, this goes back to my quantitative remarks of the previous session, but I'm avoiding formulas. So, and it's again the same question, right? So it has to do with this. So is ESG an investment factor? You may have heard of a guy called Stephen Ross, who in 76, 7, more or less, came up with an interesting theory that was an evolution, although some may disagree, but to me, it's an evolution of the capital asset pricing model. So the capital asset pricing model tells you, okay, the pricing, i.e. the spread, of any financial instrument is a function of one factor, essentially, which is the market. And it's beta to the market, so how sensitive it is to the market. The asset pricing theory says markets are not perfect. There's a number of factors that influence an asset pricing. It can be the market itself. So is the FTSE going up or down? It can be how environmentally and socially responsible is this asset? Or it can be big versus small. How much is the market cap of this company? How volatile is the company's stock price? There's a number of assets that influence the pricing. And Fama French won a Nobel Prize on this. They identified 3 assets to explain the performance of stocks. But the question is then, is ESG driving the performance of a stock or a bond? Is it influencing the pricing? Now, if we look at this, we might say no. But remember, this is a cross-section, and it's today. We don't have data long enough because we know that the market over here was already super tiny. With 3 years of data, there's very little you can do. On top of that, we don't have this. The publication in companies' balance sheets. I tell you, the easiest exercise to do will be, once we have a few years of publications, to go and understand with the companies that have a higher ESG footprint, whether their stock price or their bonds were outperforming the others. We can't do that yet. If anything, many people are arguing, and there's a big debate on whether ESG finance should be more expensive. Because let's face it, ESG compliance is expensive. It means you have to invest on filters, on social projects. And sometimes they don't give you such a great return. Speculation is definitely the best way to make money, right? In the short term. What we're arguing here is that in the long run, ESG should and will probably prevail because there is an element of moral suasion for some, conviction for others, that being compliant with ESG is in the long run more sustainable. And if that is true, it will become an investment factor. And then we're going to start seeing it in those formulas that we don't want to see, but it will appear over there as one of the explanatory drivers of assets performance. And for sure, one of the things that you guys, once you're back at work, will have to take into account to make investment decisions. That's it. Thank you. If you have questions, topics.
So my question is there like a balance between the supply and the demand of this ESG and the green bonds, or is there like an imbalance and will be balanced in the future?
I don't have the presentation anymore, but never mind. May I? Thank you. Oh, okay. Now I know how to do it. Thanks. Look at this. This is the amount of oversubscription, i.e., the excess demand over the supply. Look at it. 4.5, 1.3, 2.7, 3.3, 2.7, 3.8, 4.9, 6.7, 6.5, 11 times, 9 times, 5 times. In general, there is a very significant oversubscription. Now, for those who are more accustomed to financial markets, for a bond to have 1.5 times oversubscription, it means that you were barely successful. But here we're talking about 4, 5, 7. So if this is a good indicator, and it usually is, of how much people desire this kind of instruments, then I would say that there's a lot of room for growth. And if this is a good indicator, then this number, which is 200 billion a quarter, times 5, 1 trillion a quarter going forward, right? Because more or less average oversubscription. Yeah, and we're rebalanced by increasing the supply. The demand will grow correspondingly. But even if demand stays the same, supply has to grow by at least 4 to 5 times to fill the demand. Well, if you think about it, it's not, right? Because look at what's happening in the world. In Italy alone, at the moment, there are roughly 5 gigawatts of electricity being produced with solar. And it's less than 5% of the overall demand. Solar and or renewable energy. Look at cars. How many of your cars are petrol and or diesel, and how many of you have a hybrid car? You. There you go, and me. And everybody else has a normal car. So think about it. We still have to finance the production of all those cars. And the world is the same, right? I don't know if any of you has ever visited Africa. I was very impressed. I went to Nigeria last year. So you get to Africa, the first thing you notice is that everything, all of the vehicles are super old. They're like, we talk about Euro 5, Euro 6, Euro 7 for cars in Europe. So the least polluting ones being the ones with a higher number. There is Euro 0. So, and trucks are the same. So we still have to invest, and so raise money and invest to produce all those things. CNH now wants to build industrial vehicles that are electric, trucks that are electric, airplanes that move with solar. So there's a lot of potential supply to invest in. It's definitely more than the amount of investments. And obviously, if you look, for example, if you look at Tesla, which is a ginormous company, at least in terms of market cap, they're not borrowing 100% of their money from ESG Finance. They're not, and they could. Although some would argue that the disposal of the used batteries in electric cars is as polluting as the petrol, but it opens up to a huge debate, and we don't want to go there. Yeah.
I wanted to ask, do you think that the ESG has the power to influence the market without the influence of the regulators? And also another thing, if this happens, if this market driven, the change, do you think it can be very rapid and a risk for the non-ESG market? Thanks.
All right, so I'm generally, and this is my opinion, I'm generally quite liberal in terms of regulation. So I would like always to think that the regulator is there to give a framework rather than influence pricing, which we know they do sometimes, even if they have good reasons to do so, they do. And we've seen it in session 1. For the time being, they're not influencing pricing because, as I said, they're not telling you, look, it's ESG, you have a capital advantage. They're not doing it for banks, they're not doing it for insurance, they're not doing it for anyone, or disadvantage. The change is for now driven by the market. And if anything, by the political stance of most countries that regard ESG topics as a focus. It's become, like many other things in finance, a fashion and a good one for a change. I think the growth is going to be quite dramatic. I don't think that in the short run there is a risk of completely jeopardizing existing bonds and or loans. In the medium term, definitely. And as long as the regulation is not interfering with the process, it will be a regular churn whereby things will expire and they will be replaced by new ESG instruments. Possibly in 10 years, everything will be ESG and we are not going to call it ESG anymore because it's just ESG. There are some risks though. One of them being the so-called greenwashing. So the risk is that some people that are usually not able to raise financing, or they are able to raise financing but at very expensive terms, or they have a bad name in the market, all of a sudden find this very convenient marketing tool of white labeling their debt as ESG in order to convince investors to invest in them. But then they're not going to be compliant. And this is called greenwashing. It's a phenomenon that unfortunately has already emerged. There's a bunch of companies that are non-ESG compliant or non-compliant with the terms of their debt. Some of them did it with fraud. So they were not planning to be compliant. A regulation is intervening with the taxonomy also because of this. That is the main risk, right? The risk of using something that is born for the good of the planet and the people that live in it, and using it as a marketing tool to raise money that would not normally flow to you.
Question from our students or our community. So if you want, you can already answer. In my opinion, the first question you already answered. The second is quite interesting.
Okay, so not considering any regulatory advantages, what do you think is the ESG market share that will be achieved steadily in the long term? As I said, unfortunately, the world is full of inequalities, but in the developed world, and by developed, I mean Europe, US, certain parts of Asia, probably not China, not yet, although they are making a very significant transition all of a sudden towards ESG topics. In these parts of the world, I think it will be the dominant debt instrument in the next 5 years, whereby dominant, it means more than 50%. The rest of the world has some catching up to do, and it also has to do with the fact that, as I said, ESG is costly. So until it becomes very convenient from a pricing point of view, some parts of the world may not be so attentive to it. A quick comment on credibility of ESG credit rating. So I made it earlier, a reference to this. The ESG credit rating, well, there's no real rating agency, or at least no internationally accepted, reputable, and solid and reliable rating agency for ESG rating, like there is for credit rating. So there is no S&Ps or Moody's for ESG rating. There are a number of companies. Some of them can be influenced. And as I said, the greenwashing phenomenon in some cases may have external ESG compliance auditors being collusive with the company that is doing the greenwashing. And hopefully we'll see a consolidation in the practice of rating ESG projects into some either well-established firm, like as I said, the Moody's or S&Ps of this world, or a consolidation of the existing auditors. Have you seen a significant progress in developing metrics and methodologies beyond climate change at macro or firm level? Yes, so as I said, it all started with climate change, and it still is one of the most fashionable topics around ESG. But we've seen a number of examples, and we've seen the trend of the growing number of social bonds, which are very dominant, especially in times of crisis, when people feel the need to be socially responsible, and it's normally utilized by banks. We've seen a number of sustainability-linked ones. We will probably see an increase in numbers of social and sustainable projects in the housing, for example. I know for a fact in the UK there is a very significant market for social housing, and they are starting to make very relevant use of ESG finance to finance the building projects. Right. Is a merging of the ESG indicators for an entity with the current credit ratings expected in the future? A merging of the ESG indicators. Well, this is a very good question. If I understand correctly, it's about having some sort of standards in terms of ESG indicators for all entities. I don't know. I think there will be, because otherwise everybody sets their own agenda. And as I said, until now, it was up to the individual companies to publish their corporate social responsibility statements, talking about whatever they liked. And it's a broad enough topic to give indicators around, I don't know, how much I'm consuming my shoe soles, and therefore I have to replace the plastic, etc., to how much electricity I'm using or how much I'm polluting. Hopefully, well, the regulation for now, as we've seen, is very broad. Hopefully they will come in being not intrusive from the point of view of pricing, but being a lot more specific on which indicators to use. As always in this kind of things, it will be a mix of the practice. So with so many bonds coming out, people will start looking at a certain number of indicators, and they will emerge as the topical indicators, and regulation coming in and saying, okay, these are the topical indicators, please add also this, this, and this, and this is going to be your ESG ratios, these 5 or 10 ratios that everybody should look at.
Is there any further question? It seems not. I think we have covered through the issue. Of course, we didn't fix the matter in full. The matter is very complicated indeed. But we thank you very much for having introduced us in the matter and offered us also a perspective on how to analyze the future evolution of ESG compliant criteria, you know, in investing, in finance in general, and in corporate strategies as well. So the topic is very broad to our students. I remember that we are gonna cover somehow further these topics with specific courses, for example, on sustainability reporting, which is an important issue, and also ESG investments further. So we are very happy to have introduced this matter today, to have met Stefano Dova, and to also have met Mediobanca, which is a new relation of ours. We hope that in the future we'll have further chances to meet again. I thank you all for having attended this session, you know, in presence and remotely. And we are looking forward for the next events. Thank you very much. Thank you.
Anzi, veramente molto apprezzato, veramente buoni, ti svegli.